I think why you see a more established, sophisticated investor is because they've had more experience and they've built their nest egg bigger. And a fund does a lot more to protect that, a lot more risk mitigation there. So they don't care that they don't see the details of every deal. They say, look, I'm in wealth preservation mode now versus high risk wealth growth mode,
Exactly.
right? So if I was only in high risk, then I'd be going and buying up Bitcoin, right? Because I'd be saying, well, there's huge potential here, but there's huge risk. So these guys, they might be worth 10, 20, $30 million. They're going, look, I know you guys have experience in this field. And I feel, again, I can sleep well at night because I know that one out of these 25 properties could even be foreclosed on. I mean, it could go as bad gets. And still, I know that I'm going to see return on my capital and profit. That makes me feel pretty good, right?
This is the Real Estate Vibe Show, and I'm your host, Winky Loomba. I have my special friend with me again today, Drew Wahlgren. Drew serves as a Vice President of Investor Relations, managing both equity and lending relationships at Meg Capital Partners, a private investment firm specializing in triple net industrial real estate investments. Drew joined Meg Capital Partners in 2019 after 8 successful years as a risk analyst and program manager at Liberty Mutual Insurance. He holds a Bachelor's of Science in Finance from California State University at Hayward. Drew recently moved from San Francisco Bay Area to Dallas, Fort Worth with his wife and 2 children and enjoys woodworking and outdoors with his family. Welcome, Drew, again to the Real Estate Vibe Show.
Hi, Winky. Thanks for having me back. It's a pleasure to
Of
be here.
course. Of course. Last week, Drew, we talked about investing in current economy. And today I would like to discuss creating a fund and a fund structure because I understand that you recently got involved in that. So why did you launch a fund?
Yeah, great question. For about 7 years, we had offered direct single asset investments to our group of investors, and it was it worked. It did. The demand was there. We would fill them up very quickly, and so there's nothing wrong with that. But we saw over time as we grew as a team, as we grew as a company, you start to look around and look at the greats, the KKRs and the Goldmans out there, right? And you start to realize, hey, there's a reason that these guys, they don't do direct investments, right? They're fund structure only, or at least heavily. And so there's a reason there. And so you look around and you start to, look and go, we should be emulating some of the greats in certain ways. And that was something that we realized, hey, there's a lot of efficiencies that are available to a sponsor, to a manager, from the acquisition side when it comes to operations, right? At a fund structure, we have a lot of ability to move quicker, to move more efficiently, and have more tools at our disposal, right? And that's some of that is just liquid capital that you may need to instantly use. And I'll give you a couple things here. And one is when you launch an individual asset investment, which we had done. There's a little bit of cumbersomeness around, a little bit of awkwardness and time consuming. There's a time consuming process around putting the legal docs together, right? And it's very important, right? Anyone out there who's, you know this, Winky, and a lot of your listeners probably do too, but you really need to make sure you have a great legal team that's making sure you have a PPM that's rock solid and keeps yourself out of trouble. It's disclosing all of the risks. And you want that to be accurate, you want it to be thorough, and really tailor-made to the investment that you're making there. So, that's just really dollars, but it's also time. And that was the biggest issue was the back and forth for weeks and weeks, right? Until a PPM and an operating agreement was properly structured on each one of these. So that being said, it was a little bit cumbersome, and we found, last year we syndicated 12 individual investments, and that's great, right? But we felt like, can we do 50% more than this? Can we do twice as many? Or do we need to just do larger deals? What? How do we expand here? Because it feels like we're spending a lot of time here. Everyone's very busy. How can we do more? And we realized this is where that breaking point was, where we really needed to shift to a fund structure. So we launched our first one earlier this year. And a lot of those efficiencies that we saw and that we really predicted, really we've been able to experience as we raise the fund and we've been deploying it. And I should mention, just for the sake of legality here, what I'm talking about here is not an open offering, not a offering of a security at any point. I'm talking about something that we've launched and has since closed. But I want to talk about that experience and why we like the fund structure and why our investors like the fund structure. So, but going back to what we were doing, we have a single PPM, we have a single LP agreement, right, at the funds level, and now we could take this entity and deploy very quickly and efficiently across. We're targeting 20 to 25 properties, so we can get out there and scoop up properties very quickly and easily. And by the way, we're able to scoop up properties that are great that previously would have been too small, right? A $2 million property, it may be the juiciest thing in the world, it may be the greatest thing, but we can't
Right.
make sense of doing it on an individual level. We do take care of our team. We pay our team based on using acquisition fees. A 2% acquisition fee, for instance, is not a lot on a $2 million purchase price. How can we justify the same amount of work, the same amount of people all involved in the same transaction with a very small fee there? So we had typically been targeting larger properties, really in that kind of $5 to $25 million price range. So now with the fund structure, I don't have that, right? A lot of that efficiency is built in, and I can quickly acquire these without the back and forth with the legal team. And so, sure, this juicy $2 million property, yes, let's buy it, let's acquire it.
Why
It
not?
fits the criteria of the fund, let's put it in. And by the way, if there's more properties than less, because there are some smaller ones in there, great. There's more diversification for our investors that join that are partners with us in the fund. So no issue there from a higher number. You want to watch the amount of states that you operate in. You don't want too many K1s for a single investor. But number of assets owned, if you limit that state number a bit and make sure that's tolerable, then why not? If I have an asset in Ohio, why not have 3 more assets in Ohio, right? That's great. More diversification is always going to be better, and they're rolling up. And keep in mind, these are triple net lease properties, right? So we're not expending a lot of property management resources at each property, at the property level, I should say. So hope that makes sense, but really that efficiency is there. And I'll add one more quick thing, actually, which is we're able to use cash to really negotiate at the table with sellers and say, look, what are your needs here? And we're always looking to serve sellers and brokers' needs. What do you need here, and how can we be of service to you? And many times the types of acquisitions we make have a fuse, they have a timeline. And if we can come in and say, look, you can go with a publicly traded REIT that gives you an offer very similar to ours, but if you need us to close, we could close in 45 days instead of 90 days or even more sometimes. That is really valuable to a seller. And if we're right there neck and neck, they go, oh, these guys are going to close all cash. All they need to have is a little bit of due diligence time to, of course, get environmental surveys done and property conditions assessments. But if we can come in with cash, that's a great tool to negotiate and even maybe press the cap rate a little bit higher. So those are benefits that actually translate to an investor who joins us, where they get to enjoy the benefit of that as well, amongst diversification. And I could go on about investor benefits, but from a sponsor perspective, that's really why we looked at it, and it's been a great thing.
Exactly. Yeah, I agree with you 100%. Let's talk about a little bit more about the fund structure, like what is involved. Like you said, you have like 20 to 25 deals, and these still could be from smaller to larger deals, smaller, medium, larger, depending upon the amount that's being invested in the deals, or as a deal in itself, how much it's going to cost, and it's going to be different cap rates, right? and different ROIs for all the
Yep.
different deals. So how that whole structure is going to fit into the fund structure? If you can give us a high level view, how to manage all those deals versus a single industrial deal or a multifamily deal.
Yeah, no, there's again more flexibility here. We see a lot
Mhm.
of merits to deals that are different than the next deal, right? And they might both be triple net lease industrial assets, but you may have one that has really healthy cash flow, but the basis is a little bit higher, right? And you say, well, we have a really strong cash flow machine here, and we'll see some profits, but we didn't come into this thing at a super low price per square foot. We don't anticipate a huge amount of profit on the back end, but again, really strong cash flow. And then you might have the opposite on the other end of the spectrum with another property. Hey, cash flow is a little tight. We have some of these in the fund, right? A couple smaller properties in Southern California. That's bulletproof market right there, right? You have a very high floor to those asset values when you have an asset that's a quarter mile from the beach, right? You go,
Mhm.
and no one thinks of industrial, but there is some industrial that's a quarter mile from the beach, and we own one of those assets. And so the cash flow is always going to be a little bit thinner in a really hot primary market where there's tons of demand. But we got that at such a low basis relative to the market. We said, look, this is a little bit of a drag on cash flow, actually. We're targeting X amount. This might be a little bit tighter than that, but we see that in the future, when we sell this asset, we're going to make up for that in spades. So that's another advantage to the fund is we could take one of these assets, which, might sort of divide investors, right? Someone would say, hey, I want cash flow. I don't really care about this sort of speculative projected return on the back end. And someone else might be the opposite, right? I want that appreciation. I don't care as much about cash flow. So if we can blend that together and kind of going back to your question here, hey, you have a lot of different assets. We are looking to have a blended cash flow. Where that lands, I'm not sure yet, right? We're not fully deployed. We're mostly deployed in this fund. Again, as the investments close, we're fully committed as far as equity capital goes. But now it's up to us to continue to finish deploying that capital into these assets. So, currently there's a mix. You have things that are cash flow a little bit on the lower side, a little on the tighter side, and some that are really healthy. And they may take different risk profiles too, right? One of those may have really good cash flow, but there's, a slightly smaller tenant that might be a little bit weaker. And, when you zoom out there's always a different probability of default with every tenant. And so you might say they're not all exactly the same, right? So I might have one where I go, hey, we got a really nice reward for a little bit higher risk, right? We have a tenant here. They've been around 18 years. They do, let's just say, $10 million a year in revenue. Sounds pretty good, but in the grand scheme, that's a fairly small tenant, right? That they may be a little bit more shaken by some rough patches than a very large tenant that does, $500 million a unit revenue and can sort of withstand many small speed bumps without a problem and continuing to pay rent without an issue. So yeah, there's a blend there, and that's what we wanted to offer to investors is, hey, we're going to have some backbone real estate investments. We're going to have some ones that have a little bit more risk in there to help juice returns. At the end of the day, you're not putting all your eggs in that basket, and that's where you have the freedom to do that. And investors like that, right? Hey, I don't want all my assets just the safe stuff, right? Because the return is generally commensurate with that risk level, right? So how can I sort of get both and have some backbone assets that can support any kind of deviation, any kind of issues, right? I mean, we're heading into some choppy economic waters.
Mhm.
So as an investor, I can sleep well at night knowing, hey, you know what? I may have one, two, even three, four, five assets that run into issues. I have a lot more behind that continue to
The
pay
setback.
debt service, that can continue to distribute cash flow to me. And so again, that's what most of us want, at least, is being able to sleep well at night.
So that's good. Well, let's look at from the investor's perspective. But before that, let me ask you this question. You use our terminology blended cash flow. So can you help me understand that? What is blended cash flow? So you are giving some investors the cash flow upfront and some maybe just looking for at a big chunk at the back end. How does that work?
Really, what I mean there is, as far as a percentage of cash flow on equity invested into a property, you may have two $10 million properties. And let's just say each one was about, $3.5 million in equity required for each one. They both came from the same source, this
Right.
fund entity that's holding equity and bringing it in from investors. But you may have one that cash flows at 6%. Again, maybe that we got a really good basis and it's rock solid, bulletproof market, like I mentioned. And you have another one that cash flows at, we'll call it 9%, right? So what's that blended cash flow? Same amount of equity, all things being equal, you have about 7.5% cash flow. So that's just across
Average
two.
out.
Yeah, exactly. I just mean the average cash flow here. So, I mean, that's, now you have not every asset is the same size, of course. So, again, you have a $2 million asset I mentioned. We have a $30 million asset that I mentioned. This is about $200 million in assets that will be deployed across once fully deployed. So, we want to keep that percentage and concentration, below 20%, of course, but most of these are in that sort of $5 to $20 million range. And so each one of them is a different size and each one of them has a different cash flow as a percentage, of course, of equity. And, where, again, that's going to blend out, it's all going to get aggregated at that fund level. And, what we end up in free cash flow, it's fairly simple underwriting when you talk about triple net lease assets, right? I go, look, here are my rents coming in and my expenses are nil. Okay, so I know what my net operating income is here. Now, what's my debt service across, 20 notes that I have, right? I finance each one of these. Okay, deduct that, and there's your free cash flow. So we don't take a lot of assumptions here. So I'm looking forward to, once we get that final piece of capital deployed, we can say, okay, now we can calculate very easily what we're going to have in cash flow for at least year one. And each one of these is under a lease with annual rent increases. So we can really anticipate bumps up. And some are, 1.5% rent bumps, some are 3% rent bumps. All of these have different rent increases built in. So even that has to kind of average out and aggregate at a fund level. So all that being said, it's a lot of work getting all that out there. But relative to the fund industry, we have a very small fund, actually. We launched a fund with about $60 million in equity. At the fund level, especially when you get to the institutional level, we're talking about 150 at a minimum, a lot of times 250, 500, $1 billion funds. We have a relationship with a big group called the Related Companies. They have a fund that's $6.6 billion, right? I mean, that's the kind of level. So we launched a smaller fund intentionally. We said, look, we could raise a huge amount over a long period of time and continue to deploy. We said, why don't we raise capital quickly? And then we can get it deployed in relatively quick manner, which will be about 6-7 months here. So if we can get that out in 6-7 months, put a bow on it and say, look, all the assets are deployed. And now we're cash flowing very passively from all these triple net lease assets. Now, as an investor, I'm very happy, right? I'm getting cash flow and I have a very low amount of risk because, and I speak to this, what we've done on the individual level has always had this risk centered around single tenant default risk, right? And we mitigate that a lot of different ways, which we've spoken about. But if I can eliminate that by eliminate that by diversifying across 25 properties, there's very little risk at that point. So it's a nice place to be.
Yeah, it makes total sense. But from the investor's perspective, what does it look like? Let's say I'm the investor and then you have this fund. I wanted to invest into your fund. What should I look for? What are the do's or don'ts?
Yeah, good question. When I'm evaluating an investment opportunity, single assets are, you can get really granular, right? I can look at the price per square foot. I can look at who the tenants are or the single tenant is in our case, what their financials are, what the market looks like, the vacancy rate. You can't do that with a fund, right? The investors who have come in, even later, the very last investors, we had still only at that point, at the very last investor came in, had deployed around half of our fund, right? So they could see what we had and they go, okay, I could see what's here, but they don't know what's coming for the second half of deployed capital, right? And that's what you're going to get with any fund is a little bit of lack of transparency, and not because the sponsor's hiding anything, but just because it hasn't been deployed yet. Hey, we are going to acquire these types of assets. And usually there's some sort of criteria, right? It's going to be
Mhm.
multifamily assets in the Southeast, or in our case, it's
Mhm.
going to be triple net lease industrial assets only. There's some sort
Right.
of criteria. And so what you need to ask yourself as an investor is, am I attracted to this asset class? Am I attracted to the fundamentals? Do I see the fundamentals supporting a good return on my investment over the course of however many years, 5 years, let's say? And so if that's the case, great. I can kind of check that box. I'm interested in this asset class. Now you're evaluating the sponsor, and this is much more heavy. It really should always be the number one thing you look at, in my opinion, on even a single asset investment. But now you're putting even more trust in the sponsor because, again, you don't know what you're getting. So, what I would ask yourself if you're an investor is, you're looking at a fund. Okay, again, it's multifamily in the Southeast. What has the sponsor done on their track record? And
Mhm.
maybe it's a mix, right? Hey, they actually have about 10 properties and multifamily in the Southeast, but they've also done some retail stuff and in the Atlantic coast or something. You go, okay, they've done a few things, but they have experience here,
Exactly. Mhm.
right? And so they've done this before. They know how to acquire properties. They've clearly looked and reviewed markets in this area, and they understand which ways the winds are blowing. So that is really important. And again, you're betting on, my favorite phrase, you're betting more on the jockey than the horse.
Exactly. I think that's the case all the time. I say that all the time in multifamily too. I mean, if the operator is good, jockey is good, you're basically
Yeah,
betting on the jockey, and they can turn around a bad property or a bad deal into a good deal.
right.
And if the jockey or the operator is bad, they can totally, trash whatever we have. A good property could be like really bad property at some point. So you're basically doing your due diligence on the operator and looking at the past record, how they perform, which is very, very important. But what is the timeline for your fund, or what is the strategy there? How long people gonna stay in your fund?
Yeah, the fund we launched is a closed-end 5-year fund. So
It's
we're
kind of
looking to acquire these assets, hold cash flow, and we're looking to be fully exited by the end of year 5, right? And could that go shorter or longer? Absolutely, right? But we have a target, right? And that's generally been where we target with these types of investments anyway, right? Usually 4 or 5 years that we're targeting. And if the economy looks terrible and year 4 and 5, we may continue to hold, and maybe, we're deployed by the end of year 6, right? You want your manager to make that decision because, frankly, as if it's structured correctly and they have their interests and your interests are aligned, then you will see them really, protect that capital and make sure they're not making a foolish transaction just to sort of remain within the rules of their fund, right? You don't want that, right? I would much rather any fund manager hold my money for longer than make a dumb decision at the sacrifice of
exactly.
return. So, we have a lot of flexibility in these kinds of assets to hold, but in the past, historically, we found a lot of opportunities to exit early. And I think a lot of that's honestly just due to a really strong real estate market.
Yeah, but it might change with the fund management now because you have multiple properties, and all the properties you need to maybe target to exit kind of in the similar time frame, right?
Yep.
If I'm saying that correctly. So this is the right place to ask you now, what makes a good fund manager? Because you're a fund manager now. So what kind of qualities you have or you're looking to possess, in the coming future, since it's a new arena for you now?
Yeah, some of this overlaps really, tightly with single asset investments, right? The manager you still want the same things, a lot of the same things at least. If you're an investor, right? I still want good communication.
Mhm.
First of all, I want them to be proactive, right? Every quarter they're going to communicate. Okay, great. We just ended Q3, right? I invest with a lot of sponsors. I've been watching the Q3 reports come in, and I love it, right? I get to read through, and some of them are very good. Some are, could use improvement, frankly, right? A little more detail, a little more touching on the things that investors care about. You want to have that communication. And then behind that, the sort of other side of the communication is, can I pick up the phone and reach them, right? If I email them, do they respond? Or do I get ghosted, right? I always feel like I'm being like I'm trying to date someone and they're ghosting me when I email a sponsor. And I've had that before. It's terrible. And you go, oh my gosh, these people have $50,000 of my money and they won't respond to an email. it starts to get a little scary, right? You think,
Right,
you know,
exactly.
what
Mhm.
happened? Did the principals get into a fight? You know, is there a lawsuit? Did everyone, you know, go home? Right? These are, you know, questions that start to only come up when you stop hearing back. So some of that communications there, distributions, of course. I mean, these are just the basics, right? But at a fund level, right, what makes that management different? And it's going to be how a manager really calls capital, right? You don't want to see them flailing about saying, oh my gosh, we need your capital right now. We need it. You know,
Mhm.
they should be anticipating closings in their pipeline. But also, you don't want them to pull in 100% of their capital in the fund. Let's just say, you know, and you know, it's $50 million, let's say, right? Okay, I'm going to pull in all $50 million in a few months, but I really only have about 25 million in the pipeline for the rest of the year. Well, what are you doing? You just brought in 25 million that you are now accruing a preferred return. And by the way, you're diluting everyone's return by doing that, right? If I'm an investor, I think, well, wait, you pulled me or someone else in. I mean, all kind of blends together. But if you pulled in a bunch of capital and don't have a use for it now, you should be calling it later, right? So all you're doing is paying more dollars to more people, diluting my return as an investor, and essentially just being an irresponsible fund manager. So that's one of those big ones. You know, and we certainly have been watching that really carefully because this is the first time we've managed a fund. So all the acquisitions, that kind of stuff we can do all day long, right? We're very comfortable there. But some of these other things, it's a learning curve a little bit. So we're going, okay, let's really carefully look at what the acquisition pipeline looks like. And these things always shift. Winky, you know this, closings dates, they move, lenders shift, you know, all kinds of things, timelines. Anytime someone tells you this is exactly when we're going to close, I take that with a giant truckload of salt, right? It never seems to happen when it's projected. So these things move around. So you have to just be, you know, padding
Hands
your
down.
capital
Mhm.
needs enough, but not overly padding it. So, you know, is there a perfect answer for a fund manager? No. But when you zoom out across 5 years, you better hope that you didn't see a huge you know, dilution of returns because you really irresponsibly manage it. I think it's perfectly okay to raise too much capital. And I mentioned earlier, being able to use cash on hand to quickly close on properties is a tool. So if you can use that, that's great. But again, you know, where is that line? It's just a balance.
Exactly. Balance is very important. I think even if it's a single deal that you're doing, and especially in the fund, you have multiple deals and then you got to stay on top. So many moving parts. So let me ask you this. There's a lot of challenges for a fund manager, like strategic and reputation risk, regulatory risk, financial risk, operational risk, even the cyber risk. What are some of the biggest challenges that you have seen so far, or you anticipate and then try to overcome?
Yeah, good question. I mean, a lot of those I feel like we can overcome fairly easily by having the right partners, right? We're not going to take responsibility for managing security, right? I mean, that's going to be handled by our investor portal software, right? The
Right,
company that
exactly.
does that manages that very well. The regulatory risk, that's going to be managed by our legal team, right? Our
Mm-hmm.
securities advisory team. They are going to make sure that we're above board and doing things correctly and give us guidance on that. So a lot of those things, you know, I don't think are as hard as they seem. But yeah, you need to take on the right partners, right? You can't do it yourself. You know, anyone who thinks they can go out there and syndicate deals and do it on their own is outright crazy. They will learn very quickly. They need help because you can't. No one's an expert in all of these different fields. So, but I think maybe you know, the challenge for us, we're using a third party fund administrator, right? And again, we're using a partner who's very good at this. But really, just our finance controller and the administrator. And by the way, that administrator is also a third party auditor. This is an audited fund. So, you know, that'll come at the end of the year. But at this point, when distributions are coming due, right, we're saying, okay, let's make sure that our finance team and our third party administration company who's doing all the more complex calculations, right? There's a lot of, you know, waves of capital coming in at different times, different starts to their preferred return, accrual dates, different times that we've closed on capital and rents, closed on properties and rents started to begin. So it's a lot more complex than a single asset. So that being said, they're helping us tremendously with that, but making that interaction really efficient. I mean, we're doing that right now. We launched this fund in May. We're doing our first distribution right now. So by
Wow.
the end of this month, I don't know when this will air, but by the end of October, by the end of the following month after the end of a quarter, we get that distribution out. So we don't foresee any issues, but it's a learning curve, right? So
Exactly. Mhm.
as a fund manager, you better have those partners in place, right? Our only challenge is really just sort of figuring out the interaction and making sure it's really smooth because we're going to be doing this every quarter for the next 5 years potentially or more. So we want to make sure that, hey, we have a really good relationship. This is done efficiently. And my number one priority is making sure that, hey, distributions and a very clear report go out by the end of the month following the quarter, right? That to me is priority number one. I need that to be timely. And, I've gotten reports very late from other sponsors before, and it's not a good look, right? To say, oh, we're just busy. That's not an excuse. Your investors, you set that expectation, you need to meet that.
Mhm. Great. So with this fund now, let me ask you this question. Do you feel it's easier to raise capital having the fund versus it was easy to raise for a single deal?
For us, and this might be been a timing thing, but yes, this was immensely popular. I underestimated the amount of demand for a fund structure. I had a feeling. I said, well, I think a lot of our investors really like what we've been doing, and that's just because that's all I had seen as far as an interaction from our investors. That's all we'd offered them. So I thought,
Mhm.
well, they're popular, they fill up. People like this, and some people told me I don't like funds, right? I want to be able to see what I'm getting immediately, and that's fair. But when we launched a fund, all of a sudden people from out of the woodwork came in who we had known but had never been a partner with us on any one deal, but has sort of been interested and sort of watching right from the sidelines. All of a sudden, big investments coming in from people saying, "Yes,
Exactly.
this is what I
Mhm.
wanted." And from my experience, it's usually the more established, more sophisticated investors that like funds, right? And it's not to say that only rookie investors or less experienced or there's no correlation between fund investing and intelligence, right? But I think why you see a more established, sophisticated investor is because they've had more experience and they built their nest egg bigger. And a fund does a lot more to protect that, a lot more risk mitigation there. So they don't care that they don't see the details of every deal. They say, look, I'm in wealth preservation mode now versus high risk wealth growth mode,
Exactly.
right? So if I was only in high risk, then I'd be going and buying up Bitcoin, right? Because I'd be saying, well, there's huge potential here, but there's huge risk. So these guys, it might be worth 10, 20, $30 million. They're going, look, I know you guys have experience in this field. And I feel, again, I can sleep well at night because I know that one out of these 25 properties could even be foreclosed on. I mean, it could go as bad gets. And still, I know that I'm going to see return on my capital and profit. That makes me feel pretty good, right? So that's why you see that group of investors coming in. And you know what? They write bigger checks, really.
I have heard that before because when you have a fund, it's easy to raise capital versus raising for a single deal. So I resonate with you 100%. So your current focus is industrial, right? So industrial fund structure is different in any way?
Yeah.
Any
Oh, as far
different?
as returns go and structure to, it's still a GP/LP structure. It's very similar, right? We have a
Very similar?
preferred return and we have a split on all profits above that. So, a couple differences. We used to have a second hurdle. And so we eliminated that. We said, look, if we do well here, we're not going to take a bigger portion at the higher level. We're
Mhm.
going to have this split continue all the way forward.
All the
And
way.
if we knock it out of the park, then great. You continue to see the majority of that profit split all the way up until all the profits basically will be split at that rate. So that was nice. People enjoyed that, and we were able to be a little more flexible with the preferred return too. If someone said, "Hey, I got a big slug of cash. I got 3 million, $5 million here. If I bring this in here, could you give me a better preferred return or a little better split?" Yeah, we could do that, right? That's a flexibility again that you have, and people do that with individual assets too. But
Exactly.
But when you have a fund, you say, look, I have a large amount of capital to raise. I will give up some of sponsor return on behalf of a larger check because now I have this very large amount of investors and large amount of capital. I don't know if I want to manage 1,000 investor relationships, right? If I can whittle that down, if I have 300 investor relationships, that's a lot better, right? So yeah, we'll sacrifice some of that, and that's been helpful. We never did that in the past because we were only raising a small portion of capital at a
Wow.
time, and frankly, we didn't have to, right? As an investment group, you go, look, this thing is going to fill up regardless, but that being able to sort of scratch the back of big check writers and show them a little love back when they say, hey, I really appreciate you guys and I want to come in heavier. That's great. We'll give them a little bit of a VIP term on that.
Wow, that's good. We are out of time, so I'm going to ask you, share one golden nugget with my audience. Anything.
One golden nugget. Oh man, about anything. I would say go out there and find a short-term rental fund. This is what I'm very hot on in my personal portfolio right now too. It's a very rough industry, but if you can find that diversification I just talked about, look into it, find some sponsors with experience, and you'll find that there's going to be opportunity going forward for that top tier of short-term rental operators. Boom, I kept it very specific.
Great. So this moves us to our rapid fire round. I'm going to ask you 5 questions. You know the drill, like last time. One sentence or one word. Are you ready?
I'll try to keep it short.
All right. So what is your inspiration?
I'm looking for satisfaction, really. Life satisfaction.
That's very important. Then when you have that contentment, you come from a place of fulfillment and things happen seamlessly. So what one book changed your thinking and put you on the trajectory to success? Please share that with my audience.
Well, that's a great one. There's a book called Lynchpin, and it's really good. It's about really making yourself invaluable to an organization. And I don't know if it was life-changing, but it certainly changed my perspective. And really, if you're part of a team, you want to make yourself irreplaceable, right? And it's not to say that you have to defend your position at all costs, but really make sure that you're bringing something unique that you can't find anywhere else, because that value goes beyond so many other qualities.
That's true. That's true. You. In one word, what does life mean to you today?
I'll just say family.
Great. If you can change one thing in your business, what would that be and why?
That's a great question. I would try to eliminate some travel. I've had a lot of travel.
Yeah, remote working these days. So
yeah. It's always, when you're not traveling during COVID, all I wanted to do was get into an airport and go places. And now I need a breather. And I think this year has been very hot for investor events and conferences, and everyone's trying to get out there and make up for lost time. So I think things will settle down, but I'd like to calm that schedule down a little bit, not be on the road every 2 weeks.
Great. So today, how would you describe yourself?
I would describe myself as, oh man, that's a good one. I would call myself determined. I know it sounds self-aggrandizing, but I wake up and it's not just work, right? It's family too, and I feel like I have a goal and I want to push to it, and I like finding new goals to push towards, and whether that's lifting weights at the gym or time spent with your family, it's sometimes you get those things done just so you can get to the goal of more time with your family. So again, family is something I'm really focused on right now.
Great. So how can people reach out to you?
They can email me, drew@magcp.com, like Mag Capital Partners, and send me an email. I'm happy to chat, tell you more about what we're doing.
Thanks, Matt. I really enjoyed our conversation today.
Thank you. Thanks, Winky. Talk soon.